Hello, everybody, and welcome to the webinar. Today, we're going to be talking about increasing your bottom line and understanding your company's value. We're going to be starting in about 5 to 10 minutes, just letting people kind of join in and everything. But hold on, sit tight, and we'll get right back to you. If you do have any questions during the webinar, please use the question box that you have on the right side of your screen in the GoToMeeting section. You can fill in any questions that you like. If you have any questions, you can definitely put them in there, and then we'll answer them towards the end of the webinar. That way, we can get through the webinar pretty quickly. All right. So everybody sit tight, and we will start the webinar very shortly.
All right, let's get started. First and foremost, thank you so much for attending this. This webinar is something that I actually held in Print 17 to live. So it's kind of a little bit of an update off of that webinar, off of that live conference. So it got some good positive feedback. So I figured it would be a good way to broadcast it a little bit more to the rest of the Forover family. So my name is Ali Chishti. I've been in the print industry for the last decade or so. I started my career in printing in the paper industry at Sappi. I've been at Forover the last 6 years or so. In my time at Sappi, I've grown, and at Forover, I've done a variety of different roles. The last few years here at Forover have really been working on strategic partnerships and looking at potential acquisitions and ways that we can grow the business, but also benefit the industry and our resellers. So a lot of the material that you'll see that's being presented is a result of the time that we've spent in the industry, talking to different companies, looking at different potential partners, and there's a lot of commonality in the industry, a lot of opportunity. It's very much a lot of runway for print resellers and printers in general. And we'll just start diving in. I will say, please put your questions into the box. We'll try to get them to them by the end of the presentation. I think there's a lot of material. It's probably going to take the half hour. If we aren't able to answer the questions by the end of the presentation, we will follow up individually, and there will be a follow-up email sent out, as well as some contact information in case you wanted to reach out to myself or any other member of the print advisory team directly. So with that, we can start. So the point of the webinar is generally to provide some valuation considerations for print resellers and our partners, looking at bottom line drivers, thinking about the importance of an end goal for your business, kind of demystifying some of the terminology and business valuation. Then we'll get into talking about valuation drivers, some examples, and then we'll talk about how some small changes can really have some large impacts in increasing the value of your business. A lot of this is geared towards printers who have a lot of assets on the floor and are typically are a big part of the Forover customer base, but generally a lot of the valuation considerations and the points that are being held, that are being presented, are very much applicable to any sort of business, whether you're a print broker, a printer, it doesn't matter. These are general valuation techniques that are important to understand. Specifically, we're aiming this for our industry. So I wish I could say that there was some magic elixir here, but there really isn't. It's a lot about the vision of the owner, but generally it's sales and expenses really drive your bottom line. One of the issues in our industry, working with some of the small businesses that Forover partners with and services every day, is that we've come to realize that as a small business, you're very busy handling the day-to-day tasks of getting orders out the door, trying to drum up revenue. There needs to be some time where you can sit back and really consider how to drive the bottom line. From the sales perspective, really thinking about what your customers are asking for, whether you have a niche or not, do you have an ideal customer profile? Is there some customer that you particularly enjoy servicing in terms of the products that they ask for, in terms of the services that they ask for, because you know it's profitable, because you know they're reliable? Trying to develop that ideal profile. Thinking about the fastest and slowest growing products, not only for you, but for the industry. That actually also ties into understanding what your competitors are offering, as well as what the suppliers are trying to push or trying to advertise to you. So just one good way, obviously every attendee is a 4over customer. We don't launch products without a lot of market research. And generally, if there's a new product that's launched, it was the result of a lot of market research, a lot of discussions at trade shows. I'm looking into the size of the industry, as requests from other print resellers. So if there's something advertised on 4over or either some other supplier that you see, generally they're advertising it because a lot of market research has gone in and there's some potential in the market for this product. So use that as some sort of leading indicator for, hey, if they're offering a tabletop banner, this may be selling very quickly as an add-on product to a retractable banner, just as a quick example. Then that goes right into that complementary products. Thinking about how much time as a small business owner you're spending growing the actual business versus fulfilling the operational side of the business. That is, we cannot stress that enough, that the operational piece of making sure that the orders are getting out the door we cannot stress how important that is, because you have to service the clients that you have. But at the same time, stepping back and understanding how to grow that customer base will really ultimately increase your value as a company. And you'll see that a little bit later. On the expense side, in speaking to a lot of the small businesses that we service, speaking to a lot of the resellers who will open up to us and talk to us about their operations, one of the things that comes up is that there's a lack of understanding of profitability when jobs are being produced in-house. Understanding what the most profitable products are, understanding whether you're getting the best utilization out of your assets, understanding how your costs align with industry averages. Unfortunately, what's happened over the last 10 years or so with some of the printers and some of the pressure on the industry, is a lot of industry resources are starting to go away. There used to be a blue book that was produced all the time that had BHRs, and some printers may remember, hey, what the cost was to run certain machine. Unfortunately, that hasn't been updated, but there are printers who are still using those type of methodologies, and 4over uses some of those methodologies in-house. So in case you needed questions, and again, we'll get to this at the end of the webinar, in case you have questions about the cost to run some sort of machine, understanding pluses and minuses of certain types of production equipment, we'd like to be a resource for you. We just recognize that there's not as many resources out there. So in the interest of servicing the 60,000 customers or so that we have, we're open to providing whatever information we have. Looking at another expense-related question would be looking at your marketing initiatives, whether they're profitable or not. Obviously, you're servicing other small businesses, and getting an idea of how you generate business for yourself and giving some of those ideas to your customers and helping them grow through marketing, becoming more of a marketing partner, is a way to really increase your business, and at the same time improve your own marketing initiatives. We'll go on to the next slide. This is a little bit of a humorous slide, but I think generally there's a lot of truth to it. In our travels at 4over and talking to thousands of customers, we do run into certain kind of customer archetypes that I'd like to talk to. One is the defeatist. It's oh, the industry was so much better when I started 10, 20, 30 years ago. I used to sell 100 business cards for $100. Now Vistaprint has come in and they've stolen my market share. No one's coming to me. Look at how the prices have fallen. To that person, yes, there are some pressures in the industry, but there's a lot of opportunity still that we see in the industry for people who are able to keep up and really start to roll with the punches. the thing about like a Vistaprint, for example, is they're a public company. Vistaprint, Shutterfly, a lot of the major competitors who have kind of changed the dynamic in the industry that you on a local level face, they're public companies. They have to publish all of their information. Take some time, go to their website, see what they're offering, go into their annual reports. The great thing about these guys being public companies is they have to disclose all sorts of information that you and Forover as private companies don't have to. So just in the last 18 months, Vistaprint in their annual report published that, hey, these are the types of facilities they're opening. They're opening something in Vegas. They're opening something in Dallas. They had to disclose the acquisitions that they've made. You know, they acquired a pen provider. They had some other major changes in their transit times. All of this has to be disclosed because of the fact that they're a public company. Shutterfly, the same thing. Inner workings, all of these guys have to publish a lot of information. So use that information, try to the opposite direction, or see if there's something in the market that you can try to capitalize on. So the fact that Vistaprint has acquired, National Pen, does that mean that there's an opportunity for promo? Yeah, obviously they did a lot of research before they did that. So use that against them. You have an advantage still. The fact is that all of these online companies have to spend significant marketing dollars to reach out to that customer base that doesn't repeat their orders. If you have the relationships at the local level, you're not spending 30 cents out of every dollar like a Vistaprint does in order to attract that business again. So it's just some important consideration to keep in mind. There are still advantages to having local printing. One of the things that Vistaprint and Simpress, which is their parent company, have invested in Europe specifically, is a lot of like upload and print businesses, which are basically printers that are servicing resellers. And the reason that they're doing that is because they see a lot of opportunity in that reseller market that is accessible through their direct-to-consumer channel online. So just keep that in mind. There's a lot of positive trends still in the industry. That's one archetype of kind of some of the people that we run across in the industry. The opposite is the eternal optimist or the silver bullet. This is a picture of obviously a famous movie. It's The Field of Dreams, and the famous quote from that movie is, "If you build it, they will come." There's a lot of businesses that have kind of gone under because of that philosophy. The thought was, oh, if I only had X, the business would grow so much faster than it is right now. You can name X, can be anything. It could be a 40-inch press, it can be some digital equipment, it can be large format, it could be some sort of website. There's no magic bullet here. That's a great, if you build it, they will come is a great movie quote, but it's not great for business planning and trying to build enterprise value. While we will never suggest not investing in equipment, we just think that investing in equipment has to happen at the right time. Try to build your market out, and when it becomes time for you to when the economics start to line up, where it's cheaper for you to actually invest in some equipment and labor and ink, go for it. But for the time being, try to focus on building that market and using some sort of outsource provider. Obviously, you guys all use Forover, so you're already halfway there. But even when you're thinking about investing in some new equipment, really try to build your market out and then try to understand the economics before you do it. Another archetype is the snowflake. I can't sell this. Everyone sells this. That printer down the street sells this. I don't want to sell that garbage that guy sells. Well, the reason he's selling is because it's you don't have to be completely unique. What the most successful print resellers, printers are able to capture a customer relationship, own that relationship, and be a single source provider across all of the different needs customer may have. You want to be a trusted partner rather than just the purveyor of a single product or service. You don't have to, and this goes right into that other another customer that we see, which is like the tortured artist. They look at no one's ever put better dots on a page than this person. Unfortunately, that is required for certain types of print. But if you're printing a postcard for a local dealer that's going to be thrown in the garbage after the sale is over, let's set expectations reasonably. Let's set our pricing reasonably. Maybe that's something that you want to spend time on. That's something that, hey, you outsource. Just high level, if you have any of these characteristics, and everyone does, they're going to cost you sales, they're going to increase your cost, and maybe you're not going to increase your bottom line as much as you can. So being a small business owner or someone who works at a small business and is kind of attending a webinar, understanding what the end goal is from an enterprise perspective is very important. So what are you going to do with this company that you've built? What's your time horizon? You have to start looking at your business as an asset, not just, this is a place where I'm my own boss. The company that you've built, the business that you have, has intrinsic value. Someone eventually is going to can acquire that. There's so many different paths that you can take towards getting this business, for this business. There's so many future paths. So, hey, maybe you're in it for the long run. Hold on to the business, you can continue. Maybe you have someone that you want to pass the business on to. It's a family business. You can pass that business on to that family member after some period of tutelage. You can sell your business to all of your employees with an employee stock option plan. There are financial institutions who will focus, or consultants who only focus on doing that. You can sell to a competitor. You can sell to an investor. You can take some money off the table and sell to some sort of investor who invests in small businesses. You can wind down the business and sell off the assets, or you can basically change the business to suit, your lifestyle. Let's say right now you're very much involved in the production or some aspect of the business, or all of your sales are walk-in and you want to transition online. So you can fundamentally change your relationship with the customers as well as the way that you service them to suit your lifestyle. The issue there is working with that goal in mind. Don't think of it only as that lifestyle. You want to start thinking with end goals in mind. So let's say you wanted to continue to operate this business, and it's going to take, you'll be there for the next 10 years or so. Well, start thinking ahead. You've seen the changes in the industry. You want to start thinking ahead of what the new changes are going to be in terms of equipment, in terms of the customer needs, in terms of consolidation in the industry. Try to figure out where you want to be so that this company is positioned for an ideal exit in 10 years down the road. Think about knowledge transfer. We'll get into that a little bit more about what drives valuation. But one of the important aspects is knowledge transfer, so that you are not the sole source of information for that business. There are people behind you that if you decided to step out of that role, someone could come in and reasonably run this business without you. So think enterprise, not lifestyle business. But let's say you have a shorter time horizon. Let's say you want to sell to someone in the industry near term. Well, do your diligence. Try to identify some potential buyers or investors. Maybe it's someone, a printer within the state that has been doing acquisitions. Try to identify some value propositions for those guys. Build the case so that eventually when you do go to market, that's someone that maybe you could contact through some sort of intermediary and have a case for them all lined up. It shows that you've done the diligence. It shows that you understand the process, and it shows that eventually you can get to that point where that roadmap is built for the next buyer. Let's say you wanted to sell to some sort of investor down the road, because a lot of the industry buyers may be getting there's fewer and fewer industry buyers out there. You may have to sell to an investor. The biggest thing for an investor or financial buyer is reducing the risk. The way that you reduce risk is, number one, keeping good financial records and documentation. I know with a lot of small businesses, there is that ability to treat it as a little bit more of a personal enterprise. Short run, that may help you on a tax basis maybe, but long term, if you can't document your sales and your profits adequately, no one's going to pay you for those down the road. So it's very important that you have good financial records and documentation in place. For that, if you are looking to sell or exit your business in the near term, be very judicious, whether it's to an industry buyer or to a financial buyer. Be very judicious about debt load and how much debt you're taking on and the equipment that you're buying. And we'll go into an example next to talk about how can that impact your business. So one of the things, and again, a lot of you may know some of these terms, but just in case you don't, we're going to go through them. But one of the most common terms in valuation is EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. The reason this is a focus is when you're looking at an entity, their EBITDA is a good indication of how much return an investor can get or a business can get out of those assets, out of that enterprise. So basically it takes your earnings and it adjusts for depreciation, which is a non-cash expense. So let's say you have some sort of press and every year you take some depreciation on that. Well, that's just a book calculation. It doesn't really impact your cash flow. So you can add that back to your earnings and you can get a true cash flow. On the flip side, there's interest that you're also adding back. And the reason that you add that back is maybe you have debt on those presses, but because we'll get to cash-free, debt-free in a bit, because the new buyer coming in wants you to extinguish that debt, they may no longer have an interest payment on that. So that may be a true cash return from them. Some other terms, adjusted EBITDA. Basically, you take your EBITDA and now you adjust it for anything that's non-standard or non-recurring or unusual. So let's say, for example, that you run a $10 million print shop, you're the owner, but you also oversee all of production. If someone else comes in, they may want to bring in someone to run that production. So it may end up being that they have to pay someone X amount of dollars that right now you only take $1 of salary. They may have to decrease the EBITDA for that reason because they have to bring somebody in to essentially fulfill your role as a production operator or a production overseer. On the flip side, let's say that you own the building that you're operating out of, and you are paying above market rent from the company. Well, now your EBITDA is going to be lower, but we're going to adjust for that to get you back to a more normalized rent. So there's a lot of adjustments in EBITDA. We'll get to a little bit more how that affects your valuation. Cash-free, debt-free is another term you should be familiar with. For most, smaller enterprises, let's say under $10 million of revenue, under $2 million of EBITDA, most of the transactions are going to be cash-free, debt-free, and we'll get into that in a minute. But basically what that means is the buyer coming in is going to let you take any cash that's in the business, but they also want you to extinguish the debt. So you're going to use some of the cash that's in the business sitting on your balance sheet to extinguish the debt, because when they come in, they don't want any debt on the books, and the cash that was on the books, they're not paying for it. That doesn't make sense. Asset purchase versus stock purchase is another thing that comes up quite a bit. An asset purchase is when a buyer is basically purchasing all of the assets of the company, but they're not purchasing the name, the actual legal entity that owns those assets right now. The reason someone would do that is there's some tax benefits from a buyer's perspective to do an asset purchase, but also it reduces their liability as an acquirer. So if they acquire through a stock purchase assets as well as the corporate legal structure of that entity, they may be assuming some legal liabilities as well. And then earnouts and transition period are just something that you should be aware of. Most acquisitions have some sort of earnout and transition period in which they will maybe hold back some of the payments until some milestones are met to enable a smooth transition. So valuations are very tricky. There's not a single value for any company. It can vary wildly, and we'll go into that in a minute. But just generally, through our experience, strategic buyers will pay more than investors because there's some sort of synergy case that they can build where they offer the same products that you offer, or they have the same facility in a region that you have a facility, let's say, or you have some similar offerings. They can consolidate those and eliminate some costs, and it'll benefit them. Typically, the next point is the larger a company's revenues and profits, typically the higher the valuation. That just goes to the fact that inherently, a $50 million company with $50 million worth of revenue is less risky than a company that has $10 million worth of revenue in most cases. There's a lot more room for error in a larger company. So an investor can come in or another entity can come in and they can assume that, and even with some downside risk, they will not be at a crossroads with some small amount of decline or customer attrition or whatever. Typically, the more customers that you have and the more product that you have, the higher the valuation. So think about a company that only has one customer. And let's say they have $10 million worth of revenue just from that one customer. But if that customer goes away or that contract doesn't get signed, that business isn't worth as much because there's a lot of risk tied into that one customer. Valuation, the higher end you are on terms of revenue and EBITDA, the higher the valuation. So based on that last example of that company with that income statement, let's say that the owner gets a 4x valuation. Well, what do they walk away with? Now you actually have to go to that other part of your financial statements, which is your balance sheet, and you look at your assets, your liabilities, and your equity. So let's say you take the 4 times the $1 million of EBITDA, it's $4 million. You're going to take the cash that's on this balance sheet. In this example, it's $250,000. You're going to take that $250,000, but let's say there's $1.5 million in debt for a press that they just purchased. You're going to take that $1.5 million, and then the buyer may expect you to extinguish that debt, so that when they walk in, there's no cash on the books, but there's also no debt on the books as well. They're going to infuse some cash and they're going to run the business, but there's no ongoing interest payments for that piece of equipment. So reality, they get $2.75 million in this example. So the main takeaway here is just be very careful, because debt will eat away at your proceeds. So depending on where you are in your company's life cycle, take on more, but take it on very wisely. So let's see how a small change in an income statement can really lead to some larger changes down the road. So let's say here, someone is having $7.5 million of sales, same company. All they did was add $300,000 of broker sales. That cost them $200,000. All they did was add $100,000 to their EBITDA. Now a $100,000 increase can actually lead to $200,000 to $500,000 down the road. based on when they actually go to exit the business. The other impact it can have is, let's say that you are only selling a few products, but now you're actually creating a roadmap for the next buyer through this. Hey, there's a lot of availability of these new products out there. I can invest in, you can buy me and invest in some new equipment and start to produce that, or start to grow this relationship with this outsourced provider to increase your sales. You're basically providing a little bit of a path forward for your new owners and showing them there's additional runway in the market. You're not taking any additional debt on. And actually what may happen is, if you're able to show some sales growth, you're able to show some product diversity, you may end up with a higher multiple. So let's say previously you were going to get 3x. Now, because now there's a roadmap that's available, you might be able to get 4x. So instead of that, it looks like a small impact, but that 3.3 can go to 4.4. So never underestimate the amount of change that you can get from an enterprise value based on a small change that you're doing at the operational or the marketing level right now. So obviously you guys all know, you're all customers. We are trade only. I just have to put the slide in. We're coming right at the end, and we'll get to what some of the next steps are. But you all know we service resellers, 50,000 plus small businesses. They outsource anywhere between $100 to $5 million with us. We have over $100 million worth of equipment. We have all the facilities. So, in case you are looking to expand that relationship, if you need help trying to expand that relationship, trying to understand new markets, we have launched the print advisory in our last month with a few hundred registrants. Joe Stramel actually led that webinar. We have a confidential consultation that you can sign up for. Really just kind of spitball, understand someone in the industry, for over has a lot of experience. If you want to bounce some ideas off of us, please feel free. This is not, obviously there's some legal verbiage that will, this is not technical legal advice. You still have to do your amount of due diligence and pull in advisors where you can, but we're happy to share whatever information that we can in terms of some sort of what we've experienced in the market, what we've seen in the market. We're happy to provide that to you. I will send a link to this sign-up page.
We do have a couple questions here.
Okay, there's quite a few questions that have come in, and I think kind of just in the interest of time, what we'll do is we'll write down the users and we'll reach out independently.
Okay. All right. So then we'll take all these questions that we have to a certain email address.
Yep. Either Joe or myself, and we'll also have that print consultation. So you can set up a half-hour session with one of our print advisors.
All right, great. And again, the webinar is being recorded. Recorded webinar in there. Okay. All right. Thank you so much, guys.